Hello. Thanks for listening to our discussion on the topic Bank Strategies for Alignment with CARES Act Guidelines. Joining me today are Raj Vepamananti, Global Leader for OFSA Risk and Finance Practice, and Betsy Young, OFSA FCCM Global Practice Leader. Coronavirus Aid Relief and Economic Security Act, or CARES Act, as it is widely known, was signed as a law in March 2020. Through its Paycheck Protection Program, troubled debt restructuring, and forbearance of mortgages and student loans, etc., a $2.2 trillion support package is being extended to businesses, large and small, and individuals to fight the hardship caused due to the pandemic. Even though we are nearing the end of some of these programs, the impact of the crisis and CARES Act are here to stay for the near future. With that said, I would like to start the conversation today by asking Raj to please share the key impacts to the banks as a result of CARES Act guidelines.
Thank you for inviting me, Ravi. We are seeing an impact to banking functions. CARES Act has introduced changes such as deferral of payments of principal, interest, and fees for up to 1 year under the Paycheck Protection Program. This will impact the cash flows of the financial institution. This will require them to change the way they manage liquidity. There will be a need to better model the delays in payments. On the credit side, financial institutions need to analyze the impact to their credit risk models. Essentially, capital requirements of banks will see a change in the new situation. The current COVID 19 scenario is seeing an increase in the non performing assets. Timelines for recognizing non performing assets are being revised globally. CASE Act has given some amount of relief to banks by delaying the adoption to current expected credit loss methodology. Regulatory reporting is another area where we are seeing a change. Fed has revised the reporting form on consolidated financial statements for holding companies, the FR59C, and they've added new data items. Other reports such as call reports, that is the FFIEC 031, 041, 051, as well as FFIEC 101 have also been updated. The areas that I discussed impact the financial institution approach to data provisioning. There will be a need to capture additional data attributes to identify accounts impacted under different provisions of CARES Act, especially for accurate capital computation and regulatory reporting.
Thanks, Raj, for that succinct summarization of the impacts. As a market leader in financial risk management and analytics space, how is our OFSA product suite positioned to support our customers to address these changes?
OFSA is well placed for business users to quickly implement the changes coming about due to the CARES Act. At a data level, financial institutions can easily source data into OFSA staging, where data quality assessments can be performed and the reconciled data is ready for use. OFSA cash flow engine can capture the account level attributes required for generation of revised contractual cash flows as per the provisions of CARES Act. Deferral of payment of principal, interest, and fees can easily be achieved through business assumptions framework in our liquidity risk management application. The framework allows you to define separate business assumptions for both interest as well as principal cash flows. The rules framework can be used to capture changing business rules such as 0% regulatory capital risk weight for SBA guaranteed loans under Paycheck Protection Program. These loans can be excluded from regulatory capital requirements and leverage ratio. OFSA regulatory reporting for US Federal Reserve supports the changes to regulatory reports from CARES Act, such as update to call reports, FR59C, etc. Revised regulatory capital and supplementary leverage ratio computed in Basel can be reported in call reports FR59C, FFIC 101 quite easily in OFSA.
Sounds great. So we are indeed placed very well to support our customers' initiatives. Now let's pivot to AML, fraud, financial crimes, and compliance management, which have always been key priorities for the banks. With the ongoing pandemic situation and the significant activities involved in distribution of the enormous stimulus package, banks have to deal with new challenges. I would now request Betsy to share some insights on these areas.
Thanks, Ravi. So the SBA, FinCEN, and others are all highlighting an increase in the types of fraud often seen when an economic disruption, such as a natural disaster, occurs. In this particular case, some of the key red flags that they're highlighting are those associated with imposter scams, money mule schemes, and fraudulent loan applications.
That's very helpful, Betsy. Thanks. Lots of the banks have been dealing with significant increases in new account openings, customer onboarding, and due diligence, not to mention the high transaction volumes. How can banks leverage Oracle's FCCM suite to manage the increased need for monitoring and investigations?
The FCCM portfolio can actually help customers in several ways. One example might be leveraging event scoring and correlation in enterprise case management to group distinct events into one case and then prioritize the cases based on the risk scores. A customer might also leverage the RPA integration to automate standard data gathering tasks, saving valuable time for investigators to focus on the more critical analytical tasks of investigating a case.
We hope you found our discussions helpful. For more details and insights, please check out our white paper.